You got to learn from history, otherwise you're going to repeat it.
Good morning. Welcome to American Strategic Advisors. And whether you're an existing client or new to the firm, we're sitting here with Dr. Bob Goodman, who's an economist. And Bob, tell me a little bit about your background, your history.
Well, very briefly, started out for 2 years at the Federal Reserve Bank in New York and 2 more years at an investment firm at Citibank. And then I started 15 years with out J&W Seligman in New York. And I finished out 16 years as a partner and senior economic advisor at Putnam Investments.
Oh, it's excellent. That's quite a colorful background. Yeah. Well, we have a couple questions for you, Bob, and I know a lot of our clients are full of questions and so forth. I want to start with a hot topic, and that's tariffs. So let's talk tariffs. Tell us a little bit about tariffs and who pays them and how that works.
Well, first you have to define the word tariff. Tariff is a tax. It's like a sales tax. Who pays the tax, the incidence of the tax, depends upon a number of factors that we don't really want to go into, but it's shared by the consumer, the producer, and the country that's exporting the commodity. But it is a higher cost on the consumer. Period. End of story. It is not a good economic policy unless it's for national security purposes or it's because some country is dumping product into the United States, undercutting costs and forcing our producers out. Otherwise, there is really no good excuse. It is a very bad bargaining tool because remember, the people that we're living on have their own constituencies, their own countries, and they do retaliate one way or the other. In the end, it hurts everybody.
From your perspective, do you think that it will slow the economy down a bit, or what do you expect would happen if this tariff path continues?
Again, all told, net, it will slow down growth because consumers will buy less as prices go up. That's natural. It has the unintended consequence of causing world growth to slow.
So let's pivot a little bit towards the markets and towards the economy at large. And so a lot of questions we get relate to investments and where should young people put their money today? We get a lot of those types of questions, and I want to spend some time talking about that as well.
Young people have an asset that older folks do not have: time. And I want to make that point. Time is an investor's best friend. The more you have it, the more you're able to take risk, more you're able to wade through bad periods, and you get the good period. And people will say, well, is it a good time to get in the market? Is it a bad time to get in the market with everything that's going on? Then whether you get in the market is that you get in the market. And what we've seen over long periods of history is that the longer your investment horizon, the better your return. We're now just the very beginning of the artificial intelligence era. Think back 20 years ago, the beginning of the internet era, and what that spawned, the opportunities that weren't there 20, 25 years ago, and now we take them for granted. The productivity increases. So if you ask me, the potential for a young investor looking out 15, 20, 30 years is as good as it's been since the 1980s for a longer-term investor. I know 80-year-olds that invest like 30-year-olds. And I know 30-year-olds that invest like 80-year-olds. It's backwards. It is, people want to buy when things are going up. You don't have to buy things when they're going down. They want to sell when things are going down, and you want to buy when they're going. It's totally backwards. If you understand the logic, you can deal with this.
You sound a lot like us. We preach a lot of the same thoughts. But I want to talk a moment about the debt, right? So this country carries a fair amount of debt. So let's speak to the percentage of the GDP as the debt relates. And do you think that is an acceptable level? Should we try to have no debt at all?
This conversation could have and did take place in 1980, when the level of our debt was about $3 or $4 trillion. Today, it's 34 trillion. It's a lot. So people back then let the debt frighten them out of making a longer-term investment, and that proved to be a terrible mistake. Understand one fact that's missed. The United States is in a unique position. We are the only country in the world that can serve as a reserve currency. Think of what happens when things get a little squirrely in the world. Where do people go? In China, in Russia, in Germany, in France. Where do they go with their capital for protection? Here, the dollar. Because the dollar is a numeraire. Everything is denominated in dollars around the world. We have a very deep capital system. We can handle trillions of dollars, and we do. Whether you like it or not, we have a stable government. Your money can get in this system and out of the system easily. No other country in the world. We don't go to the yuan or the ruble when we get scared, do we? Nobody does. You can talk it down, but we don't. So what really is important and what you got to focus on is the great rate of growth of your debt relative to the rate of growth of your economy. Once your economy grows faster than your debt, and the debt ratio, 6.5% or whatever it is, that the GDP begins to go down even ever so gradually, you want to talk about bullish long-term signs, that's one of them. Now, what is important is not the 34 trillion bucks. That's a distraction. What's important is the ratio of our debt to 34 trillion to the size of our economy. And to be fair, it's been growing. That over the years could become a real problem. I was good at picking trends. I mean, I caught the trend in the 80s early, that supply side move, because before that, all of our economic policies were demand side oriented. They were Keynesian to deal with a certain specific problem of demand. We were in a depression. How do you get people to spend money? In the 80s, it changed. Our problem no longer was a demand problem. It was a supply problem. So rather than have demand side economic policies that spurred consumption, you had to develop supply side policies that enhanced production. And so what did you do? You rewarded corporations to give them incentives to be more efficient. You lowered their taxes. And you did things that were completely anathema to Keynesianism. But they worked. And they worked because they were appropriate. And turned out pretty good.
So you were right.
Well, but it takes too long. I told you this story. I remember going to an investment meeting where a very good analyst came in to make a pitch on a company. He loved the company. We got to have this. They bought the story. They put it in 3 or 4 funds, lots of it. And you wait. Week, 2 weeks, a month. Went down, around, nothing. Market was going up. It was, after 4 months, they let the guy go. Literally.
And then the next,
Give me 2 more months. This stock is flying. And I remember being in an investment meeting and the CEO said, boy, that stock is doing great. Where did so-and-so go? He was so right.
and they already have fired.
That's the problem. It doesn't happen instantaneously. Have your convictions. Be ready to change if your assumptions change. I mean, on the economy, if my assumptions change, my view would change. I'm not married to. But that's the problem. Is so many people are afraid to take a position that the committee doesn't seem to go there.